Hello. Indian government bond yield curve flattened in the month of April as yields of newly issued 2-year and 5-year government bond yields failed to attract enough investors in their primary auctions in April. Yields of newly auctioned 2-year government bond hardened from its initial cutoff of 6.65% to around 7.33% by the end of the month amid significant selling in 2 to 3 year segment by PSU banks on account of profit booking. Similarly, yields of the 5-year benchmark government bond hardened from its initial cutoff of 7.37% in mid-month and ended the month at around 7.77%, up by around 40 basis points according to Bloomberg data. In comparison to that, yields of the benchmark 10-year government bond yield hardened by around 37 basis points to around 7.77% on end April. The sudden and unexpected spurt in newly auctioned government bond yields resulted in risk-averse sentiment among market participants, which resulted in devolvement of both 5-year and 2-year government bonds in the first month of the financial year, something which has not happened in the last couple of years. Yields of AAA PSU bonds followed the path of government bonds amid FPI outflows from debt in April. 2-year, 3-year and 5-year AAA PSU bond yields hardened between 45 and 50 basis points in April, causing significant amount of stress among investors. Apart from FPI selling, fixed income investors also focused on relative underperformance of the rupee against the US dollar as well as other emerging market currencies and hardening of the crude oil prices. The rupee weakened around 2.3% in April and around 4% on year-to-date basis against the US dollar. This generated some macroeconomic headwind for the country, while other parameters pointed towards continued improvement in the economic activity. So, what should investors do? We believe there is value emerging in 2 to 3 year segment of the AAA PSU bonds at around 820 to 830 level. This segment has got battered amid the recent sell-off by the FPIs and lack of inflows in fixed income mutual funds in April. With the recent changes in the FPI investment guidelines by the Reserve Bank of India, as well as announcement to purchase bonds from the secondary market, we believe that the worst may be over for these short-term bonds. We expect gradual easing in yields in this segment over the medium term. Risk to our cautiously optimistic view comes from further hardening of the crude oil prices beyond $75, as well as further weakening of the rupee against the dollar, which could prompt further selling by the FPI in this segment. However, any further hardening in this segment should be viewed as an opportunity to add, as risk-reward ratio is gradually moving in the favor of the investors over the medium term, in our opinion. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.